Welcome everyone to Vested Interest. This is Shane, and in this video we are going to cover the three stocks and the one new ETF I'm going to be looking to add to the portfolio in September, and that will be Union Pacific Railroad here out of the industrial sector, Comcast out of the communication sector, and Procter & Gamble out of the consumer staple sector. And I have been buying Comcast and Procter & Gamble for quite a while now. They continue to be under my price that I'm willing to pay for them, so I'm going to continue to add to them. So let's get into the video and see why I am looking at these three and what is the ETF I'm looking to add to the portfolio for the month of September. All right, first up on the list is Comcast Corporation, ticker CMCSA, out of the communication sector. Closed out last week at $33.97. Looks like it was down a little bit in the after hours as well. Does have a market cap of $125.42 billion. Current price to earnings ratio is 5.65, very low, with the forward P at 7.79. It does pay a $1.32 annual dividend, so divide by 4 because this is a quarterly payer, with a starting yield of 3.89%. Very nice starting dividend yield on this one. Ex-dividend date, if you're interested in the next dividend, you need to be buying before October 1st. Don't wait till the October 1st ex-dividend date. You will not get the next dividend. You want to be buying in September or before. Definitely don't wait till October 1st. Looks like they pay out on October 22nd. 52-week range as low as $31.03, so not too far off its 52-week low, and as high as $45.31. A beta of 0.92, so less volatile than the overall market. The analysts call it a consensus buy. Price target of $42.86, which represents a potential of 26.17% upside. The earnings date is also coming out in October 30th, so tune in for that if you are interested in watching their earnings call or listening to their earnings call. Now, jumping over to the right, I like to look at dividend yield theory to see if the company is potentially undervalued. To do that, we look at their 5-year dividend yield average, 2.61%. We compare it to their current 3.89%. Since it is higher than their 5-year average, that speaks to potential undervaluation. And for this one, that's significant potential undervaluation, again, at least according to dividend yield theory. Now, looking at the payout ratio, I like under 75%. They're sitting at 21.23, so well below what I'm looking for as far as payout ratios. We went over the ex-dividend date and dividend payout. Return on capital employed is another one I like to look at. Return on capital employed, I typically like above 10%. This one is not quite there at 9.30, but not too far off either. EPS growth, I like above 5%. They're forecasted over the next 5 years at 6.08. And revenue growth is forecasted over the next 5 years at 1.47. I also like growing free cash flow over time because companies can do some things with that free cash flow. They can pay down debt, make acquisitions, reinvest back into the company, carry some of that cash on the balance sheet as cash or cash equivalents, buy back shares, and raise their dividend over time, which is what we want as well. So looking at this one going back to December 2021, 17 billion in free cash flow. Looks like December 2022 they were down to 12.6, but we're going to look at repurchase of shares and see what's going on there here next. December 2023, 12.9, so back up, and 2024, 12.5, trailing 12 months at 16.5. So it looks like their free cash flow is a little bit up and down, but some of that can be accounted for in the repurchase of capital shares and how they're doing that. Looking back to 2021, look at here, 4.6 billion in repurchase shares, and then huge jump up. So even though it looks like their free cash flow went down, part of that is because they went pretty bonkers in their repurchase of shares up to 13.3 billion. Look at that, huge jump. December 2023, not quite as much as 2022, 11.2. So I would call this actually a downturn in free cash flow in 2023. See that? They went just slightly above in free cash flow, the 12.6 to 12.9, but then down significantly in repurchase of shares to 11.2. And then same thing in 2024, down to 9 billion from 11. So looks like actually over the last couple of years that we may be seeing decreased free cash flow. Maybe that turns around in 2025. We'll have to wait and see. Some other metrics I like to look at here, revenue, you can see up and to the right, and that is what we want to see. We want to see growing revenue over time. Profit margin is also growing over time outside the 2022 down year, and significantly so here in the trailing 12 months, 18.44% profit margins. EBITDA, earnings before interest and tax depreciation amortization, is also up and to the right, which is what we want to see. Total assets, it's pretty flat actually, 273.85 billion. And we want to look at total assets minus total liabilities. I want more assets than liabilities, right? So down here, 176.39 billion in total liabilities. So they have plenty of assets to cover their liabilities. Total debt, 101.53 billion. It seems a little elevated, but again, plenty of assets to cover liabilities, so and their total debt is also decreasing. See, that's decreasing slowly over time, which is what we want to see. And then we look at cash and cash equivalents. So cash on hand, they're sitting on 9.69 billion. So that means they can continue to pay that dividend with no worries, continue to pay down debt, make additional acquisitions if they want to, whatever they need to do with that cash. But it's nice to see a nice, healthy cash on hand balance. And shares outstanding also is diluted. And whenever you look at shares outstanding, there's basic shares outstanding, at least on stockanalysis.com, basic shares outstanding and diluted. Basic shares are just the shares out in the market that the shareholders hold and dilute, or I'm sorry, that the public holds, and then diluted includes the shareholder shares as well. So you want to be looking at diluted so that you can see all of the shares, because some of these companies issue stock-based compensation. So you want to make sure that there is stock-based compensation as well as the regular shares that you and I buy are coming down, which you can again see that clearly decreasing over time, which is what we want to see. We want shares pulled out of the market so we are more of a shareholder over time as we purchase these companies. All right, so that's Comcast. Overall numbers look pretty good. Again, revenue up and to the right, profit margins up and to the right, EBITDA up and to the right, decreasing shares outstanding and decreasing debt. Total assets over liabilities, plenty of assets over liabilities to cover if they needed to, and some cash on hand. Nice to see. All right, next up on the list is Union Pacific, ticker UNP, out of the industrial sector. Closed out the week at $223.57. Looks like, again, they were down in the after hours slightly. Market cap of $132.59 billion. PE ratio 19.43% current. Forward PE a little lower than that at 18.19. Dividend $5.52 annually. Again, quarterly payers divide by 4. Starting dividend yield of 2.47. Ex-dividend date August 29th. We are past that. Looks like they paid out on September, or are going to pay out on September 30th. So, if you weren't buying before August 29th, whatever you have holding currently, you'll get dividends on September 30th. If you buy them now, you have to wait, several months after this next payout. 52-week range, $204.66, as high as $258.07. So they are not quite right up against their 52-week low, but leaning towards their 52-week low compared to their 52-week high. This is one I wouldn't mind seeing more of a pullback over September, which is part of the reason it's on my buy list. A beta of 1.05, so they are slightly more volatile than the overall market. Analysts call this one a consensus buy as well. Price target of $255.91, which would represent a potential 14.47% upside. Earnings date October 23rd. So again, if you're looking for the next earnings date, tune back in October. Jumping over here to the right, again looking at their dividend yield theory here to see if this one was potentially undervalued. 5-year dividend yield average at 2.16%. Compare that to the current 2.47%. Since it is higher than their 5-year dividend yield average, that speaks to potential undervaluation. Again, at least according to dividend yield theory. Not quite as undervalued according to dividend yield theory as we saw with Comcast, but nonetheless still potentially undervalued. Payout ratio, again, I like under 75%, 46.57%, so plenty of room to continue to raise that dividend. Doesn't look like they're in danger of a dividend cut. Return on capital employed at 15.99%, well above the 10% I'm looking for there. EPS growth, again, I like over 5%. They're sitting at 9.44%. This is nice to see here as well. Revenue growth forecasted at 7.33% over the next 5 years. Very nice overall. Now looking at free cash flow, $6 billion in 2021, down in 2022 to 5.7 billion. 2023, same thing, down to 4.7 billion. Looks like it was back up in 2024 to 5.8, and trailing 12 months looks like 6.2. Let's look at repurchase of shares. 7.2 billion in 2021, 2022 6.2. So definitely a downturn in 2022. Same thing with 2023, down to 705 million. Back up in 2024 up to 1.5 billion. Looks like 4 billion here in the trailing 12 months. But again, keep in mind, in 2025, we're in September now. So we are still waiting on a few months worth of reporting in the trailing 12 months. That's not all 2025 numbers, does include some of 2024. Looking at their deeper dive into their numbers, revenue again up and to the right, most current, actually looks like it's up and to the right and then flattened off the last 2023, 2024 and the trailing 12 months, 24.399 billion. I'd like to see that increase a little bit, and hopefully we will over this last quarter plus here. Profit margins Yeah, it looks like again they've flattened off a little bit, but not bad. 28.43 billion there in the or 28.43% over the trailing 12 months. EBITDA slightly up and to the right, 12.37. Total assets has been increasing, 68.58 billion here, and looking at again over liabilities, 52.38. This is closer than I would like it, but not terribly so. And you got to keep in mind, there really are not a bunch of companies running to get into the railroad business. It is a very hard entry to get in. You've got to have miles and miles of tracks. What's really happening now is these larger players like Union Pacific are buying out some of the smaller players, which recently, I think it was Norfolk Southern or another company that Union Pacific is potentially looking to buy out. So that's really what's happening with these. So slower growth on these possibly, with some acquisitions over time and some of these becoming larger players in the business as they gobble up some of the smaller players. Total debt 33.968 billion. They do have 1 billion on hand, and total shares outstanding, again diluted, includes all of the shares, so that's one you want to look at, is decreasing over time, which is what we want to see, right? So not quite as good a numbers as we saw with Comcast, but not terrible either. EBITDA up and to the right. Revenue looks like it's maybe flattened over the last couple of years. Profit margins 28.43%. I'm good with that. Assets is increasing. Liabilities was increasing. It looks like it's flattened out over the last couple of years, but we still have more assets over liabilities, have some cash on hand. Total debt kind of flat, taking shares out of the market. So overall, I like Union Pacific. Again, very hard barrier of entry for a company like this, so that's part of the reason they're in my portfolio. All right, and number 3 on our list is Procter & Gamble, ticker PG, out of the consumer staple sector. This is, again, one I've been adding to and nibbling on, 1 share here, 2 shares there for the last several weeks. I'm going to continue to do that as long as they are under about 160. Close out the week at $157.04. Looks like they were actually up in the after hours, 157.25. Market cap of $367.85 billion. Current price to earnings ratio 24.13 seems a little elevated. Wouldn't mind more of a pullback on this one for a built-out company like this, but I feel like they're always a little elevated, with a forward PE a little lower than that at 22.46. Current dividend is $4.23. Again, that's annual, so divide by 4, with a starting dividend yield of 2.69%. Ex-dividend date way back in April, but that hasn't been updated, right? Because if you look over here, ex-dividend date was the 15th of August. The 7th of July or 18th of July, and they paid out on August 15th. So that is not updated. And again, that's why I recommend more than one source. You can see the Stock Analysis and Finance, Yahoo Finance are the 2 sources where I'm pulling this information from, and that's why I recommend more than one source. Actually, you can see their ex-dividend date is way outdated. Should be over here. Should be this is this, and I know it's that one because I just got paid from Procter & Gamble here not too long ago. 52-week range as low as $149.91. Would love for it to drop right up against its 52-week low over the next month here so I can add a little bit more. And a high of $180.43. Beta of 0.37, so this one is less volatile than the overall market. Analysts call it a consensus buy. Price target of $177.67 would represent a potential 13.14% upside. Earnings date, if you're interested in that, October 17th. So a lot of earnings dates coming up in October. Jumping over, looking at dividend yield theory again, 5-year dividend yield of 2.41% compared to their current 2.69%. And again, since it is higher, speaks to potential undervaluation on this one as well. Now, this one has the highest payout ratio at 62.62%, but still under the 75% that I'm looking for. But something to keep an eye on. And maybe you have a lower threshold. Maybe you like 60%, maybe you like 65, maybe you like 55. I don't mind under, maybe like 70. I don't mind under 75%. So for me, this is still fine. But again, as it gets up in the 60s, 70s, it is something to keep an eye on. Return on capital employed on this one, 24.23%, so well above the 10% I'm looking for there. Earnings per share growth forecasted at 6.31%, so that's over the 5% that I like. Revenue growth forecasted at 4.15%. Looking again at free cash flow, June 2022, $13.5 billion, 2023, $13.7, 2024, $16.5, trailing 12 months, $15. Repurchase of shares, $10 billion in 2022, $7.5 in 2023. So it looks like a little bit of a downturn if you look at free cash flow plus the repurchase of shares. Does look like a downturn in 2023. 16.5 and 5 billion pulled out of the market in shares. So that does look like they went back up in 2024. Trailing 12 months, 7.3 billion so far. But again, keep in mind, trailing 12 months does include part of 2024. So we'll have to wait and see exactly what the next quarter plus September looks like. All right, looking at revenue growth again, up and to the right, 84.288 billion 2020 so far in 2025. So good to see overall there. Profit margin 18.61%. I'd like around 20%. So this isn't bad. EBITDA, earnings before interest, tax, depreciation, and amortization, again up and to the right. Total assets sitting at 125.23 billion compared to their total liabilities at 72.95 billion. So plenty of assets to cover liabilities if they absolutely had to. Total debt does actually look like on this one is going up slightly, which we don't like to see that, but not terrible. 36.53. They do carry 9.56 billion on the balance sheet as cash and cash equivalents. So cash and cash equivalents, that's cash plus anything they could sell really easy. That's pretty liquid. Maybe it's other investments that they have going. That's what the equivalence means. So 9.5 billion. It doesn't look like, again, they're very worried about or very in danger of being, not able to pay their debts. So I'm not real concerned about that. Shares coming out of the market as well. Again, nice steady decrease in shares pulled out of the market. Overall, good numbers on this one as well. Again, this one's not going to be, a fast-growing tech company. This is going to be a nice, steady, preserve your capital with some growth and a nice dividend payout on something like this, which is why I like it. All right, and since we have covered the three positions I'm looking to add to that are already in my portfolio, this would be a potential new one that I have looked at recently. It is Vanguard's Total International Stock ETF, VXUSS, or US, VXUS. It is one I am considering adding to the portfolio. Currently at $71.37. Looks like it was up in the after hours actually as well, $71.98. And some of the things to look at for this are you want to look at the payout ratio, or I'm sorry, expense ratio, right? You want a low expense ratio. This is the amount you are paying for this ETF. So 0.05. So low expense for anything under, 0.1 in my opinion is low. 0.05, 0.06, 0.03, 0.01. The lower the better, obviously, but this, in my opinion, is a low expense ratio at 0.05. PE ratio, I'm not as concerned with stuff like this. 15.86 is the average because it's all the different stocks in it, and it does have more than 25 holdings, but these are the top 25 that we'll look at in a second. Ex-dividend date is June 20th, 2025. I don't see where their payout is, so you'd have to look that up. They do pay out quarterly. Payout ratio is 43.4%. 52-week range. Low of $54.98, 52-week high 72.46. But this being an ETF, this would be like VTI in my portfolio, SCHD. I would just dollar cost average into this probably on a weekly basis. Beta is 0.79, so less volatile than the overall market. Top holdings here, you got Taiwan Semiconductor. I'm not sure exactly what that is, whether that's, I have to look that up. SLCMT 1142. I'm not sure what that is actually. Tencent Holding Limited, SAP, Market Liquid, again, same thing. I'm not sure why they have an NA on those. ASML, Alibaba, Samsung, Nestle, Roche, AstraZeneca, HSBC, which is a bank, Shell, that's an energy company, Novartis, which I know a lot of people are buying right now, Commonwealth Bank of Australia, Toyota Motor Company, Siemens, Royal Bank of Canada, Mitsubishi. I know this is one that I believe this is actually in Warren Buffett's portfolio. Novo Nordisk again. I said Novartis was one people are buying. I think it's Novo Nordisk is the one that people are buying. Shopify, Sony, Unilever, Schneider Electric. So the idea here is I do have a couple of foreign companies in my portfolio. Vale is one. It's a mining company out of Brazil. Enbridge is another. It's a company, energy company out of Canada. But I do not know a lot about, Samsung, I recognize that. Nestle, I recognize that. Some of these I recognize. Tencent Holding, I know that's a Chinese company. Alibaba, I held that at one point. I know that's a Chinese company as well. Toyota, obviously, I know Toyota. Siemens, I know that one as well. But like Royal Bank of Canada, I don't bank in Canada. I don't know enough about Royal Bank of Canada. Mitsubishi, I know that one. Novo Nordisk, I do recognize the name, but I don't know a lot about them. Shopify, I recognize the name. Sony, obviously, I recognize the name. Unilever, I think, is a lot like Procter and Gamble. Schneider Electric, I only recognize that because I'm in the construction business and I understand what that is. But this, it would be a way to get exposure to a lot of different foreign markets, right? It's VXUS. It's all of the different companies outside of the United States stock market. Vanguard's total international stock market, right? So it's all the companies outside that. And again, there are a lot more than 25 holdings here. I think there's well over 1,000. But this would be a good way to get exposure to the rest of the market without having to do a lot of deep dive and understanding other markets out there, which is part of the reason that I'm looking to add it. It has a nice starting dividend yield at 2.74%. And its growth, did it have the growth here listed? Maybe it did not have the growth listed. Nope. So you have to look at what its year over year dividend growth is, but I believe it was around 6%. So not bad dividend growth and not bad starting dividend yield. And again, a way to get exposure to foreign markets without having to do a lot of deep dive into foreign markets and understand what's going on with them. All right, so a little bit more information here. Payout ratio 43.4%. Dividend growth, there it is. I thought I had it somewhere. 5.62%. So just under 6%. That's around what my actual portfolio grows on a year over year basis. So not terrible growth, as well as exposure to the rest of the market, or international market anyway, and a nice starting dividend yield. I am thinking about adding this to my portfolio in the month of September. Probably will add this to my portfolio and just add it to my weekly buys to SCHD and VTI. Let me know what you think of Vanguard's total international stock market, ticker VXUS. If you have any others that are similar to it, I know that there are some others out there that are similar to it. This is the one that I was looking at. The cost basis is 71.37. I could throw in with the rest of them and be able to add 1 share a week or 2 shares a week, depending on where it was. Obviously, I would have loved to have been adding them back here at the 52-week low, but they are where they are. And again, ETFs, I'm just looking at dollar cost, something to dollar cost average into every single week, regardless of the market. And then over time, I'll get the average of that market. And this gives me nice exposure to the overall international market. I also looked at VWO, which is an emerging markets ETF as well. So let me know what you think of VXUS, or if you have one similar that you dollar cost average into on a weekly basis. Love to hear from you down below. All right, here are some other ones I think that are still undervalued, and Union Pacific is actually in my overall weekly or monthly buys, so that one shouldn't be on here. But Pfizer, General Parts Companies, Owens Corning, it's starting to go up a little bit. So this one might come out next month. Badger Meter is one I actually considered looking at adding, but I'm going to add to Union Pacific instead of adding a new position. Leidos, Occidental, that one's actually come back up a little bit. Chevron's still down there. Vale's still down there. Chubb, Nexter Energy. There are quite a few other ones that are still undervalued. Let me know what you see as undervalued in the market right now. What are you looking to add to in the month of September? And are you locking in gains? Again, I think I'm starting to see some people out there, some videos out there, people locking in gains. Nothing wrong with that. If you've got, a set gain that you want to lock in 90%, 80%, 70%, whatever it is, and you're locking in gains. I do that as well from time to time. There's nothing wrong with that, but I'd love to hear what positions you are locking in gains. And if you are locking in gains, what are you looking to use that? Are you just waiting for a pullback for something else? Are you looking to roll it into other funds? Are you looking to hold it as cash on your balance sheet? Or maybe you hit some hard times and you're looking for some cash to pay down some bills or something like that. Love to hear from you down below. Let me know what's going on in your portfolio. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Drop a comment down below. Let me know what you think of the video. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. And let me know what you're buying for the month of September, as we are finally in September. Quickly wrapping up another year here. Can't believe, we're already in September. Where did 2025 go? But this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. And hey, happy Labor Day. Hope you had a great Labor Day weekend. Spend some time with family and friends. Thanks for stopping by, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion, and if that's your educational and entertainment purposes, investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.